going to go ahead and get started. Hopefully everybody or close to it is here. Hi, welcome to the year-end financial and economic outlook for credit unions, brought to you by American Share Insurance and Excess Share Insurance, and featuring Mr. Bill Hampel. My name is Dave Kettlehake, and I'm the VP of Sales and Marketing here at American Share. So before we get going, I've got a little housekeeping, as you can probably guess. All lines are muted and all cameras are off. But if you'd like to ask a question, please do so in the Q&A box that you see. It should be at the top of your screen. As we go, we'll keep an eye on that Q&A box and hopefully be able to answer questions as they come in, unless we get a little behind. So we'll do our best. Also, if you'd like a copy of this presentation after the fact, please email either me or Bill directly. You see our contact information on the screen there, and we'll make sure to get a PDF to you as soon as we can. So we'll dive into the presentation here in just a minute, but before we do, I'd like to share just a little bit about our two companies. ASI has been in the business of protecting credit unions for over 50 years. Yep. 50 years. And just like credit unions offer a choice to their members, we offer a choice to credit unions. In fact, when it comes right down to it, ASI is the credit union advantage. And here's why. ASI offers greater coverage than federal share insurance because we insure up to $250,000 for each and every account of a member. So you got a member with $5 million? Okay. Open 20 accounts and all 5 million can be insured. Second, ASI is an insurer, not a regulator, and that's a really big deal. Our sole purpose is ensuring that your members' deposits are safe from loss. And lastly, ASI is a business partner, meaning, so instead of taking a one-size-fits-all or one-size-fits-one approach, we work with our credit unions and state regulators to develop flexible programs that focus on meeting the needs of your members. So just like your credit union, or your members own your credit union, our members own us. ASI provides primary share insurance for more than 1.3 million members in 10 states, and not one member has ever lost a penny in an ASI insured credit union, showing that ASI truly is the credit union advantage. Let's talk about ESI for a second. ESI has been very, very popular the last year and a half, 2 years especially since the Silicon Valley issue happened. So ESI helps credit unions attract new deposits, protect what they already have, and retain their largest accounts. Coverage from ESI is customizable, which is great, because it allows credit unions to insure deposits up to $5 million per member over the NCUA limit. So whether those accounts are large IRAs, money markets, business accounts, or public funds, if you can do that, ESI can help you protect those deposits and will work with you to determine the best coverage limits available. Through our excess insurance programs, we currently insure nearly 350 credit unions in 35 states and the District of Columbia. We just recently added Montana, Wisconsin, and Louisiana to our states of operation, and welcome, you three. So use ESI to attract, protect, and retain more members and more deposits. Let's talk about our speaker today. Many of you already know Bill, and if you do, then no further introduction is necessary. But for those of you that don't, it's not a stretch to say that you're in for a great hour of economic insight. Following a very long and successful career as chief economist and chief policy officer for CUNA in Washington, D.C., Bill's now an economic consultant specializing in explaining trends in the economy and financial institutions, especially on a level for people like me, and it's just perfect. So besides his tenure at CUNA, he's held a number of positions while in the credit union space, including being on the board at Summit, as a staff member at Navy Federal, that's pretty cool, and as a board member with the National Cooperative Bank. And if that's not enough, he's currently a board member at Premier America Credit Union in California. Bill holds a doctorate in economics from Iowa State University, and he and his wife Diane live in Tampa, Florida, where he really plays too much pickleball. We've had Bill on a couple of times, and also in the comments, if you think of somebody else you'd like us to have in a future webinar, let us know and we'll consider that as well. But I always ask Bill for a few paragraphs to ask, what would you like me to say to introduce the economy and to introduce your talk this time? And instead of paragraphs, he gave me one sentence. And that sentence is, following a long period of recovery from COVID, the economy is either A, settling into a soft landing, or B, on the verge of a recession. There you go. So Bill, thanks so much for being here and to help us understand the economy in general. And please take it away. You have the floor.
Thanks, Dave, and a good afternoon. Yeah, good afternoon or morning, depending where you are, to everyone. Yeah, that question of what the economy is right now is essentially what the Fed wished they knew the answer to for their policy over the coming 18 months or so. And so what I'm going to be talking about for the next 45 minutes or so is what's going on in the economy. Are we certainly are not yet in a recession. Some people have suggested, for the last 3 years, people have said we're in a recession. We've been nowhere near a recession for the last 3 years. But we're on the border where we might be. So we're going to talk about that, also inflation and interest rates. And then on the credit union side, I'll talk a little bit about liquidity and credit quality and credit union earnings. So next, a couple of years ago, most economists, me included, were expecting a recession sometime last year. And in fact, this is a quote I pulled out of a presentation I did last year. I did 2 years ago saying there would be a recession sometime last year, relatively mild, but a recession. And the reason I expected this, and other economists did, was the yield curve had been inverted for a while, and that is typically a very powerful and accurate indicator of recessions. And also, history told us that we had just had a big run up in inflation, and we have never been able to bring down as much inflation as we had 2-3 years ago without doing serious damage to aggregate demand in the economy, consumer and business demand, and thus causing a recession. Well, let's see what happened next. That recession hasn't happened. And I've been told today that I need to explain this joke to those who may be under 35 or so. Having egg on your face means you are immensely embarrassed. And so we were, because actually in my long and unstoried career as an economist, I had never, ever before actually forecast a recession. And the first time I didn't happen. So anyway, there you go. So what happened? Let's see next. Yet. Okay, it hasn't happened yet, but it very well could. Here are the two reasons that we expected a recession. I'm going to introduce you to Fred, my best friend since I retired full time from at the time CUNA. Back then I had a staff of statistician and data analysts who would put together all sorts of stuff for me. Now I'm on my own, and so Fred is this wonderful tool from the Federal Reserve Bank of St. Louis, where you go on Fred, you ask it for some data, you ask for a chart, you can edit the chart, bingo, download, you got a PowerPoint slide. So this is from Fred, and for future reference, we'll see quite a few of these in the next little while. The shaded areas are periods of recessions, periods when the National Bureau of Economic Research Recession Dating Committee called a recession. They call them after the fact, but these are ones when we've had recessions. And this is the Consumer Price Index on the monthly data on a trailing 12-month basis. So each month is looking back over the previous year and what was the CPI, the Consumer Price Index rate of inflation. And even as an economist looking at this chart, I can tell that whenever inflation goes way up, we get a recession. And of course, this is the standard notion that when inflation rises, the Federal Reserve has to react to that inflation. They do that by pushing up interest rates to pull down the inflation. As a result, they do pull down aggregate demand and cause a recession. So this is up until this is the CPI up until July of 2022 when I made that forecast before. If we go to the next slide, this is the other thing I was talking about, which is the inverted yield curve. In this case, what we've done is we've taken the 10-year Treasury rate and subtracted the 3-year Treasury rate. Mother Nature expects long-term interest rates to be higher than short-term interest rates. And so when long-term interest rates are higher than short-term interest rates, you subtract the 2-year from the 10-year, you'll be above the zero line. However, whenever the yield curve is inverted, when 2-year rates are greater than 10-year rates, the yield curve, the line here is showing an inverted yield curve. And once again, if we look before each of the shaded areas here, we see we were blessed with an inverted yield curve sometime before the recession. And looking there on the this is again this is till now, but looking into a couple of years ago, the yield curve had been very deeply inverted for quite some time, which led us to expect a recession. So hence we expected a recession. We'll go to the next slide. So we need to try to figure out why. I was going to say economists, but it must have been the yield curve who got it wrong. And I'm going to go through a number of things here explaining why the recession didn't happen. And then also for each one, I'm going to talk a little bit for the future because that gives us an idea of where the economy is headed for the next little while. First, just in general, many rules of thumb haven't worked in the aftermath of COVID. A big change is that the revealed attitude of senior supervisors to their more junior workers working from home has changed quite a bit in the last few years, or at least if it hasn't changed, they've been suppressing their actual disdain for it. But a lot of other things have changed since COVID. Another thing that happened in COVID, and we noticed this big time in credit unions, as we'll see later, households accumulated huge amount of savings. During COVID itself, especially in the first year of COVID, when a lot of things were shut down, most people didn't lose their jobs. They stayed working, but they were working from home. They couldn't go out and spend money. So what happened? They built up cash balances. Also, there was significant government support payments for those who did lose their jobs, which also allowed them to build up savings. The total amount of excess savings, and excess savings is defined as the amount of savings that has been accumulated over and above what would normally have been expected had the savings rate stayed at its pre-COVID rate. So those excess savings grew to about $2.5 trillion, which is a lot. By now, they're largely depleted, except for some really high-income households. For about 90% of the population, the excess savings have been used up. The really high income people who don't spend quite as much of their savings, they've got more, they still have stuff left over. Now, how that was used up is that people were able to keep spending more than we otherwise would have expected them to because they could spend more than their income because they were bringing down savings. Now that they're mostly used up, looking ahead, the excess savings will be less of a buffer against a possible recession in the near future. So for the next slide. The real consumer durable spending on the left, the message there is that households have not stocked up on durable expenditures like washers and dryers and trash compactors and things like that as they normally do in a booming economy, and therefore there was still some excess demand available. Automobiles on the right-hand side, this is millions of units annually since 1975. And what we see here is that car sales for the last 4 years have been actually quite weak compared to the peak level of over 17 million at an annual rate through the first part of the century, and then also in the second half of the teens. Again, households have not been spending like crazy to build up these durables, which is another reason that the economy didn't slow down, because households weren't cutting spending; they just kept spending at a fairly modest rate. Okay, on the next slide, another reason that the yield curve got it wrong is the mortgage rate lock meant consumers were shielded from rate increases. I've seen estimates that 60 to 70% of homeowners have mortgages with interest rates of less than 4%, most of them closer to 3%. Because adjustable rate mortgages are not very common here in the US, that means that the big run up in interest rates didn't bite into the budgets of households. Furthermore, and this was what was really kind of weird about this, usually when interest rates rise, when mortgage rates rise, the demand for new home construction plummets because people don't want to spend big, because of the high interest rates. What happened this time is that the big increase in interest rates dramatically reduced the supply of existing homes. This is the mortgage rate lock. People didn't want to sell their houses, so they didn't put them on the market. Therefore, those people who were looking to buy a house, since the demand for the supply of existing homes was so low, they were shifted over into demanding new construction, and so that the demand for new construction held up or actually even increased despite the high interest rates. That was just crazy bonkers, not what we normally expect for changes in interest rates. So home construction has remained quite strong for the last few years, keeping us from falling into a recession despite what the yield curve might have led us to expect. There have been some other rate increases that are going to have a growing effect in the next few years, looking ahead. Consumer loans, consumer loan rates are substantially higher than they were. This is starting to bite into consumer loan demand. Also, commercial loans, small business loans, and medium-sized business loans at banks and credit unions are typically on a 3 to 5 year rollover. So some of those loans are going to start rolling over from the really low rates they were made at 3 to 5 years ago, and that's going to be a bite on business balance sheets. And then just looking ahead a little bit, I'll get to rates a little bit later on. We all know that can't say that. We all strongly believe that the Fed is going to start cutting interest rates next month. But it's very likely that over the next couple of years, the Fed rate reductions are not going to push rates back to where they were immediately after COVID. In other words, zero for short rates. That interest rates are going to fall, but going to probably fall to more normal historical levels instead of the incredibly low rates we saw just after COVID. This is just a picture of, I don't have a nice series going back this far in credit union loan rates, but this is just to give you a feeling of the market. This is commercial bank loan rates quarterly since 2020. And it just shows that although mortgage people are locked in by the mortgage rate lock, the interest rates on other sorts of consumer loans have gone up quite substantially. The average bank rate there, and this is on 4-year paper, so which is not very typical loan, but even for those short loans, it's around 8.5%. So these rates will start having an effect on consumer spending. Here's a biggie. Inflation came down faster than we expected it to. Remember, one of the two reasons we expected a recession is we've never brought down inflation that high without causing a recession. But it came down much faster than expected, and so far it's without causing a recession. And we'll see we see a picture next. So this is the CPI trailing 12-month average. But before I showed it to you up until June of 2022, now I'm showing you since then to July of this year. The number that just came in last week is that the 12-month look-back consumer price index is up 2.9%. There's a lot of content in that number. First of all, notice how inflation has plummeted, as it has plummeted in the past. But in the past, every time it has fallen that much, it was accompanied by a recession. Basically, the slowdown in demand of the recession is what caused the inflation to fall. We've had inflation plummeting, and we're up until now, nowhere near starting a recession. The other thing that's sort of psychologically meaningful about this is, as you may know, the Fed's target for inflation is 2%. And actually, they use a slightly different number. This is the consumer price index. That's the one all normal people look at. The one the Fed looks at is the PCE, Personal Consumption Expenditures Deflator. And that's the one they want to be at 2%. That guy usually runs about half a point lower than the CPI. So the target, consistent with the Fed's target of 2% for the index it looks at, the PCE, would be 2.5% for the CPI. This is the first time since way back in 2021 that the CPI, the PCI, sorry, has had a two handle, as they say. The first number before the decimal point is a 2, and we want it to be a 2. We want to be 2.5. but it's been falling and getting closer to 2.5. So this is really good news for inflation. And households still think inflation is very high. And the reason for that is that from 2021 and 2022, prices went way high, and prices have not gone negative. Prices haven't fallen since then, but the rate of increase in prices since then has gotten back down to the Fed's target. And of course, what also is true is that household incomes have risen just about as much. Median household income has risen just about as much, and wage rates have risen just about as much as inflation. But people apparently don't pay as much attention to their pay stubs as they do to the number they see on a milk carton or at a gasoline station when they drive past it every day. But anyway, inflation has come way down without yet causing a recession. This is the more recent numbers on inflation, just to see what's going on. The last one was showing you for a few decades. This is since 2010. This is again the 12-month moving average. The average interest rate, the average inflation rate for two things. There's the all items, which is the CPI for everything, and the core is where we take out food and energy. Have averaged just under 2% for the 11 years from 2010 to 2020. With COVID and its aftermath, the top line CPI, the all items rose as high as 9%, and the core got up to about 6.5%. Since then, they're both back down, and we see, again, the latest number for the top line is 2.9%. For the core in that chart, it's 3.2. But the story is that recently, short-term inflation is just about getting back to the Fed's target. So understanding how this happened, as I've said before, it fell a bunch without causing a recession. Duh. I remember back when it was first going up, a lot of economists, me included, said it was transitory, and then when it lasted longer than that, we called it temporary, and we were laughed at. But it does kind of look like it was temporary now. It's just about back to where it was a couple of years later, and this is because the rise in inflation in the 2 years past COVID had three causes. One was the COVID supply chain interruptions. Factories were closing, shipping was shut down, people were still making money, but they didn't have stuff to spend it on, especially durable goods, because they couldn't ship them, we couldn't make them, and services weren't available because everyone was working from home. So the supply chain interruptions were a significant cause of inflation. The second one was we had two large stimulus programs during the pandemic. We had one at the end of the Trump administration and another one of similar size at the beginning of the Biden administration. Those both increased aggregate demand. They gave consumers spending power, and that aggregate demand contributed to the inflation. And then also the war in Ukraine, when Russia invaded Ukraine, that did a lot of damage to petroleum prices, which are worldwide price, and food prices, and that also pushed up inflation. The fact that inflation has come down so quickly without a recession suggests that of the first two, the supply chain interruptions were probably more significant than the aggregate demand effect of the stimulus package effect on inflation. And that's probably because the stimulus package happened in a world where a lot of people were not working and weren't getting back to work yet. If we had a stimulus package like that now, when we're just about at full employment, bam, you'd have inflation through the roof. But in the context of a weak economy coming right out of COVID, those stimulus packages probably didn't do that much harm to inflation. And they probably also kept us from falling into a recession worse than the one in 2008 and 9. Looking ahead, inflation expectations are anchored, and this is what's important for the Fed. Another reason to expect them to cut interest rates soon. I get these expectations called the break-even tips rate. You look at 5-year Treasury securities and the interest rate paid on them, and compare that to the rate paid on 5-year Treasury inflation-protected securities, TIPS. Those are Treasury securities where the value of the bond increases frequently during the year, according to the rate of inflation. So they're basically inflation indexed. And the difference between the rate on TIPS and the rate on regular bonds is the expected rate of inflation. And right now, the 5-year expected rate of inflation It rounds up to 2. It's like 190 something. And the 10-year expected rate of inflation is 2.1%, which is what the Fed wants to have. So they've done pretty well there. Finally, and this is the biggest reason why the recession that we expected hasn't happened, and that is the job market has just remained remarkably resilient. We've had a very strong job market for the last 2 years since some of us erroneously projected a recession. So let's see why in the next slide. Actually, I'm going to show you several slides on this because this is really remarkable and has a lot to do with what happens in the future. Okay, so this is monthly non-farm payroll changes. This is the number that comes, one of the numbers that comes out every Friday, first Friday of every month, and it shows the net number of new jobs added to the economy. I've run this up through February 2020. I just randomly, of course, that's the month before the doo-doo hit the fan with COVID. Notice during the Great Recession of 2008 and 9, we lost 9 million jobs over that couple of years. In late 08, early 09, we were losing 750,000 jobs per month. Since then, in the recovery and the expansion following the Great Recession, we picked up 23 million jobs. And a number to remember is that during this long period of expansion from 2010 to 2020, the average monthly job gain was 190,000. That's why I cut the previous one off at January of 2020, because this is the same data, except the scale here is totally messed up because in March and April of 2020, we lost 22 million jobs. And that just totally messes up the scale here. It scrunches all the other numbers together so you can't see anything. But so the only thing to remember here is it's the same 9 million jobs lost in the Great Recession. We gained 23. Remarkably, in 2 months, we lost 22 million jobs. But we got a lot of them back in the next few months and more than that back in the next couple of years. We've recovered 28 million jobs since just after the bottom of COVID job losses. So we now have 6 million more people working in the US than were working just before COVID hit. Next slide. So this is the similar information, but just focusing more detail monthly in the post-COVID period because the numbers around COVID were crazy. So this is starting in October of 20. And a couple things here. Notice that the monthly job gains were huge in the first 2 years, going through 2020, 2022, and even into the beginning part of 2023. Remember I told you a minute ago that the average during the 10 years after the Great Recession was 190,000 per month. That's the whatever color that is, greenish, bluish, whatever that line I've drawn on this chart here is 190,000. So know that the average, the monthly job gains were huge over the last since COVID, than compared to previously. Since this is slowing down though. If you look for the last 6 months or so, this does appear to be slowing down. And the 3-month moving average is now 170,000, which is just below the 190. But that's not a recession. Means this number goes negative. This number will be negative for several months in a row for this to qualify as a recession. We're not there yet. But also the market is pretty sensitive now. Notice that last number there for July was 104,000 or so. Or 110,000. It was a very small number. And that spooked the markets and the stock market tanked. Everyone said we're going to have a recession. Of course, over the next couple of days, people thought again and said, yeah, everything else doesn't look so bad. And now the stock market is I think it's slightly higher than what it was just before that Friday when everyone panicked for a couple of days. Okay, next slide. This is going to be the other way we look at the labor market, and this is not the monthly jobs from the jobs numbers from a survey of institutions, of businesses, and government agencies and the like. The company, people who do the hiring. This is a survey of households, and it basically they don't knock on the door, they call you. And they ask questions like how many people over 16 in the household, how many are working, how many who are not working are actively seeking work. If you're not working and actively seeking work, you're unemployed. and they add U to the people working, and that makes up the labor force. Divide those not working, actively seeking work by the total of them and workers, and that's the unemployment rate. It's up to 4.3%. This is going back to 1980. So notice if you look across this chart all the way back, the 4.3% we're at now is just a little bit higher than it was in 2019, just before COVID. And then but it's still lower than anything going back to 2001, and it's lower than the entire history before then. The unemployment rate is rising, but it is still very low, is in other words, the message here. If we look at the next slide. This is since COVID. Just before COVID, the unemployment rate was at 3.8%. Right after COVID, it jumped up to 14.8%. I believe that's April of 2020. And actually, if you take all the discouraged workers who dropped out, it was closer to 20 or 25%. But it came down quite quickly. And this is how strong the job market has been for the last couple of years. This is why we haven't had a recession. 28 months with the unemployment rate below 4% means that household incomes were being fueled, but that household incomes were pretty strong because a lot of people had jobs, and their wages they were getting weren't soaring, but they were going up a little bit faster than rate of inflation. And in fact, twice in last year, the unemployment rate hit 3.4%, which is the lowest it had been going back 55 years, which is just incredible. It has been rising the last few months. It's now at 4.3%. So if we go to the next slide. Actually, let's go back one slide. I'm not sure if I have this on another slide or not, but some of you may have heard of the SOM rule. The SOM rule says that if the unemployment rate for the latest 3-month average is at least half a point higher than it has been in the 3-month average has been in the last 12 months, a recession has started. And with this 4.3%, the average for the last 3 months is 4.1. The lowest average for the previous 12 months is 4.6. So we have just triggered the SOM rule. So by the SOM rule, we are now in a recession. The trouble is that the SOM rule has never shown this when, I won't go back to the previous slides, has never shown this when we were still adding close to 150 to 200,000 jobs per month. Usually when the unemployment rate rose in the past, when the SOM rule was correct, the monthly job numbers were negative. We were losing jobs. The reason the unemployment rate has risen this much is that the labor force has been growing pretty quickly recently. So we have more people working, but since we have more people looking for work, the unemployment rate has been rising. It's been rising for two reasons. Number one, the labor force participation rate is increasing. More people are getting back into the labor market. And number two, immigration. A bunch of the immigrants who are coming in, we've had a lot of immigration in the last couple of years. A lot of those immigrants, when they come in, get qualified to work pretty quickly, and therefore they're looking for work, and so they're increasing the labor force. So next slide. These are a few more reasons why we're not. Why they basically show a really strong labor force that is looking slightly less strong than it was last year. Is basically the message here. These are initial claims for unemployment insurance. These are good numbers. They're not from a sample. They're reported every week, and they come out weekly, so it's a nice frequent data set. And notice again, when on the left-hand side of this, if you look at when we have a recession, the layoffs just quickly, sharply rise before a recession, and it's when these layoffs are happening, we have job losses and the SOM rule is triggered. But that hasn't happened yet. On the right-hand side, I'm concentrating just on the last 2.5 years, and this shows that the weekly layoffs, the unemployment compensation, insurance compensation, or the layoffs, got as low as around 200,000, which is about as low as it had ever been for the last 60 years. and it's slightly up off of that, but still the latest number we have is 240,000 and I think this is a 1 month moving average I have here, which is still way lower than it has ever been before in a recession. So this again is not signaling a recession. If this number keeps rising for the next few months, that's a different story. Next slide. And this is just a couple more on the labor market. This is the quit rate. This is the proportion of workers that quit their jobs each month. When the economy is really weak, people don't quit their jobs because they don't think they can get a new job. When the economy is quite strong, when the labor market is strong, people quit their jobs either because they already have a new job, a better job that they're going to go to, or they feel pretty confident that they can get a new job. So the quit rate is sort of an inverse indicator of it's a positive indicator of in a weird sense, of the strength of the job market. The quit rate after COVID first of all, this only goes back to 2000 if you look on the left, because they didn't collect this data before then. This comes from by the way, from the JOLTS survey, Job Openings and Labor Turnover Survey. It's my favorite named survey, but they only started the JOLTS survey back in 2000. The quit rate has been coming down, which means workers feel a little bit less confident, but the quit rate is still very high by historical standards. It's now as high as it was in the booming years of 2005 and 2006. Last one on the labor market is the next slide, which is something we were hearing a lot about for the last few years, is that the number of job openings was greater than the number of job seekers. That's weird. Usually normal is we have fewer openings than job seekers. So from 2002 until 2017, the red line, which is the number of openings, was less than the number of people looking for work, which kind of explained why we had some unemployment. Since COVID, the number of open jobs has been greater than the number of job seekers. It's like an excess demand for labor, strong labor market. Notice that the gap is narrowing, but it's still there. So again, these are all indicators of a strong but somewhat softening labor market. So if we go to the next slide, the job market has remained remarkably resilient. Like I said before, most indicators is still strong but weakening. So next slide. Sorry, Dave. Summing all this up in terms of a recession or not, this is gross domestic product through the second quarter of this year. This is quarterly data going back to 1998, and in each quarter, for each quarter, I'm showing the inflation adjusted increase or decrease in GDP at an annualized rate. The three sections of red, the red bars are quarters during which we had an official recession. So we had kind of a mild recession in 2001. We had the nasty Great Recession in 2008 and 9, and then the COVID recession of 2020. I actually noticed the note up there. I'm excluding the second and third quarters of 2020, because in the second quarter of 2020, the annualized shrinkage of the US economy was 30%. During the third quarter, the annualized growth of the economy was 32%. And so if those were on this, you wouldn't be able to see these lines here. They'd all be crouched next to the zero line because of the scale being for those. So I've ignored those two, but they kind of wipe each other out for the most part. But notice that recently, when we expected a recession in 2023 and 2024, we didn't get one. The economy slowed to around 2% in the first half, but was back up around over 4%, around 4% in the second half. So far this year, the economy has grown at almost a 2% rate. And actually, the long-term sustainable growth rate for the economy, which depends upon the growth rate of the labor force and the increase in productivity, the long-term sustainable growth rate for the economy is somewhere between 2 and 2.5%. The average of all of those little bars there you see on that one page is 2.3%. So it means the economy right now is growing at about the average of what it's been, of the growth has been for the last 20 plus years. So next slide, please. Summarizing the economy, And this goes back to the question Dave was asking in the introduction. Has the Fed defied the odds and pulled off a soft landing? The fact that I was expecting a recession 2 years ago means I didn't think they could pull off a soft landing. And a soft landing means the economy has slowed enough to tame inflation without causing a recession, which means you slow it down gradually but not too much, Goldilocks, which is awful hard to hit, but so far we look like we may have hit it. Of course, the other option is that the economy has slowed down to what could be called a soft landing, but the negative forces in the economy are such that it's going to keep slowing down over the next 6 to 12 months, and we'll end up having had a recession, not a soft landing. Each one of those views can find support in the recent data. We have slowed down to a soft landing. If we level off where we are now, we're in a soft landing. If we keep slowing down, we have a recession. It's usually economics is not that simple, but this time it is. Even I can understand it. And the important thing is each one of these outcomes is consistent with an inverted yield curve. The inverted yield curve simply means that investors expect interest rates to fall. Usually, the inverted yield curve happens when inflation is high and the Fed's pushing up interest rates, and by investors expecting interest rates to fall, it's because they expect a recession to cause interest rates to fall. But an inverted yield curve just means investors expect interest rates to fall. And as we see, the Fed is about to start lowering interest rates because they hope we're in a soft landing. We get the decline in interest rates that the yield curve was expecting anyway, even without a recession. So what does the Fed do? Next slide. So this is what the Fed has done in the past, and the Fed only really drives one of these rates, the Fed funds rate, the dark black line, the overnight rate. The 10-year Treasury is driven by market forces. But for quite some, what we see here is this long downward trend from the late 1980s in long-term interest rates to the incredibly low numbers coming right after COVID. We had the 10-year Treasury like it's 40 to 60 basis points off and on day to day. It's now back up sort of closer to a normal, but the Fed funds rate has risen much more. If we look at the next slide, we see it a little bit more recently, focusing on the recent past. The Fed's, after the recovery from the Great Recession, the Fed started nudging up the Fed funds rate slowly in 2016. And then when things looked like they were slowing down in 2019, and then when COVID hit, they dropped the Fed funds rate to zero until a little over about 2 years ago, they started raising it again, and we've been at between 5.25% and 5.5% since then. Notice that the 10-year Treasury has been kind of really bouncing around. The market so far late this year and this year, almost 5% and then down around 4% and then up to 4.6%, and it's back down to 3.85 now. I didn't check today. So the market is expecting some changes in interest rates, is what that's telling us. If we look at the next slide, we know that the Fed's going to start lowering interest rates. They've basically told us that. And if you look at the Federal Open Market Committee dot plot, that's where they record the estimates of all the various members of the Open Market Committee and put them on a page with dots. So it's called the dot plot. It's important to realize that each of the members of the committee is not saying what they plan to do with interest rates. It's their expectation of where the Fed funds rate will be given their assumptions about everything else going on in the world, including the economy. But the dot plot suggests 3 25 basis point rate cuts in 2024, which would bring the rate down to 4.5 by the end of the year, and a total of 2.25 in cuts by the end of over the following 2 years. Probably going to happen sooner than that, and that would mean a terminal rate of around 3 to 3.25. So that's saying the Fed so far is saying that we're going to lower the Fed funds rate over the next few years to around 3%, and then leave it there until something else bad or good happens. The Fed funds futures market, this is from the Chicago Mercantile Exchange, says the rate, I actually would edit this if I had the chance, rate down by 75 to 100 basis points by December. It's not going to fall by 75 to a level of 100. It's not like 1 3/4 falling to 100. That means the rate's going to drop by 75 or 100 basis points by December. In other words, 3 or 4 cuts of 25, 3 or 4 cuts, one more than 25, 150 and 225s. The question is, coming back to where the economy is, are these rate cuts soon enough to preserve a soft landing, which we're just about in, or are they too little, too late, meaning the Fed has waited too long and that we will have a recession? And again, I don't, this is like a 50-50 call, so I'm not going to risk getting egg on my face again by saying which one I think it is. I will say the reason we might be a little bit concerned is that monetary policy works with long and variable lags. And so the effect of the high short rates we've had for the last few years is going to be persisting for the next year or so. And the effect of the reductions in rates we're getting for the rest of this year and on into next year may not hit right away. So maybe it's 45, 55, if I had to make a guess between those two. The other thing to keep in mind is that the Fed is very data dependent. And so that the weaker the economic data as it unfolds, like the monthly jobs numbers and the GDP reports, if those hold up, if the monthly job numbers hold up at north of 200,000, and if the unemployment rate doesn't go any higher than where it is now, we're going to get slower Fed funds rate reductions, especially next year. But if the unemployment rates keeps ticking up and if the other job numbers get worse, we'll start getting some 50 basis point meeting cuts instead of just the 25s. Okay, so next, moving on, is a little bit about credit unions, since almost everyone on this meeting is of and by and for a credit union. The post-COVID, this is this excess savings buildup. We had really remarkable liquidity flows in credit unions, and this also was true for community banks. Loans outstanding in 2020 during COVID grew by only 5%. Deposits exploded by 20%. In 2021, loan growth picked up a bit. Deposit growth was still really strong. 2022, when interest rates started rising dramatically, we found that our non-maturity deposits were actually instant maturity deposits when there were other alternative places for that money that were paying market interest rates, and we really didn't want to pay market interest rates on all of them, especially early on in the game. So loans outstanding took off in 2020, especially in the first half of the year, and then deposits actually shrank in the second half of the year, so we had not much deposit growth. Last year, 2023, deposit growth, loan growth slowed a whole lot, mostly because we didn't have as much money to lend. The loan growth we'd had in the previous year and the short deposit growth was giving us really tough liquidity issues, and so we were raising our rates, and also we had to because we were paying more to keep our deposits. And even then, deposits only grew by 1.7% last year. And I bet most of you were paying more than 1.7% in dividend and interest rates on all your shares and deposits last year, which means you saw a net decline. So far this year in the first half of the year, and I've not annualized these data because they're seasonally, things are goofy, of course, as you know, for loans and savings. Loans have only grown 1% in the first half of the year. Of course, we tend to get more loan growth in the second half than the first half. Shares and deposits have grown 3%. But we get most of our deposit growth in the first half of the year, so that's not a really strong number. So to the next slide, the result of this is that the loan to savings ratio in credit union, the loan to deposit ratio, kind of fluctuates typically between 70 and 80%, but it takes quite a while for it to get from the highs to the lows. A couple of years ago, we were at in 2018, just before a couple years before COVID hit, we were at 85.2, which was the highest it had been at for a long, long time. I know a lot of folks were asking me to talk about liquidity management back then. Bang, in just a couple of years, we got down to 70.2%. That was COVID. But then we very quickly got back up to around 85% last year. And the first half of this year, we're off just a tad to 84%. So this has been a kind of a wrenching experience, a lot of adjustments we've had to make in managing deposit flows and also loan demand and loan flows. So the next slide is credit union delinquency. If we are moving toward a recession, It's kind of good to know what that might mean for credit quality. The light greenish bars here are years during which we had a recession. And notice in 1990, despite the recession we had then, delinquency kept falling. In 2001, we had a recession. Delinquency kind of rose a little bit, not much. We had a big increase in the Great Recession of 2008 and 9 because that was indeed a really nasty consumer affecting recession. So far this year, delinquency rates are, oops, this looks scary, up quite a bit since the bottom in 2021. However, if you recall 2 slides ago, don't go back, Dave, but if you recall 2 slides ago, loan growth has been very weak for the last couple of years, the last year and a half. And this is the denominator effect. It's kind of the normal proportion of the huge volume of loans we made 2 and 3 years ago are now becoming delinquent, and we haven't added as many new loans to the books, and so that's why the delinquency ratio looks higher. I'm not at all concerned about the delinquency rate. It's around 0.8% being unusually high. It's because of the denominator effect. And the next slide shows if we do have a recession, what does it mean for credit quality? Households are pretty able to withstand a recession because their household debt payments are at almost record. You ignore what happened there in the couple of years after COVID because that was goofy with transfer payments and those sorts of things. But in normal times, the total amount that households pay for mortgage and consumer loans divided by their monthly disposable income is around 9.5%. That is incredibly low, and as you can see on that chart, it's way lower than it's been for most of the last 50 years. So households are in good shape to withstand a recession. We'll see that again in the next slide. This is instead of the ratio of monthly payments to monthly income, this is the ratio of the outstanding amount of total debt to annual after-tax income. And it is almost back to the normal like of 75 to 80. It's a little above that. It's 88.5%, but it's way down from where it was back in 2006 and 7, just before the Great Recession. And the other little note that I have in the bottom right-hand corner of that is that the credit card debt is less than 10% of annual after-tax income, which is a really small amount compared to all the other debt we have. A lot of people are worried about it. It can tend to be concentrated in a smaller number of households, but also a lot of what's counted as credit card debt is actually just rollover. People who don't roll over, but they pay the balance in full every month. They use their credit card as a debit card with a 1 month delay, but the balances at the time that the recording takes place are counted as if they are credit. So this means that the household sector is in pretty decent shape going into a recession. They're not overspent, and their savings are still pretty high, and their debt levels are pretty low. Okay, next. Finally, credit union earnings. I participate once a quarter with the up until last year was the CUNA Economist. Now it's the America's Credit Unions Economists. We get together and have a Zoom meeting for a couple hours and talk through an economic and a credit union forecast. And we have, for the last couple of years, been expecting a sharp drawdown in credit union earnings because we thought that with the run-up in interest rates, that the bulk of credit unions would find that their cost of funds rising more than the return on assets. So we thought that net interest margin would be shrinking. And we got that one right too, didn't we? We got that one wrong. From 2021 to 22, the net interest margin went from 260 to almost 290 basis points. And for all of last year, and it's the first quarter, not the first half. The first quarter of this year, it's been to 300 basis points, though. That's not the culprit of the bottom line down there falling from 107 basis points to 65-ish basis points for the last 15 months. The two culprits are, first of all, non-interest income fell by about 25 basis points. And the main reason for that is, of course, is the slowdown in mortgage refis. The gain on sale from making and selling mortgages has largely evaporated, and that has reduced our non-interest income. Operating expense went up a little bit, But loan loss provisions are the main culprit. They've gone from 6 basis points in 2021 to 55 basis points the first quarter of this year. That explains all of the difference there, essentially. And what's going on here is, I don't know if this is COVID or if it's, actually, I do sort of know. This is partially COVID, and it's partially the normal credit union reaction to an expectation of a slowdown in the economy and a weakening of credit quality. But what I do know is that from just before COVID until now, the ratio of the allowance for loan loss to credit unions has gone from about 8.8% of loans outstanding to about 1.25% of loans outstanding. And we charge off about 60 basis points of loans outstanding a year. So your credit unions as a whole are sitting on 2 years with the charge-offs right now. Is that because of COVID, or is that because credit unions think that loan losses are going to rise that much? I'm not sure which one it is, but I am pretty sure that a couple of years from now, our net income is going to look a lot higher than it actually is, because we'll be burning down some of these excess allowance accounts. If you're a fan of generally accepting accounting principles, I hope you had your ears covered for the last couple of minutes. But we are understating our income right now by overstating our loan losses, either for CECL. If I said COVID before, I meant CECL. Either for CECL reasons or just normal credit union conservatism. So that's my story.
Bill, we do have a question.
Okay.
Do you also have the trend in early stage delinquency 1 to 2 months?
I've seen it. I don't have it on top of my head now. It's not collected for credit unions. It's, some of the credit bureaus collect that sort of stuff, but I haven't seen it. So I don't know what it's done. Yeah, if there are no more questions, again, if you want our slide deck, there's my email address there, or you can get it directly from ASI. And I hope you might find this a bit useful. Thank you.
Yep. Thank you, Bill. I'd like to thank everybody for joining us today for this economic update. And of course, thanks to Bill Hampel for sharing his wisdom and insight as always. We still have our contact information up on the screen. So if you would like to have a copy of this presentation, please let me know and I will get you one. Bill and I are gonna go back through and fix 1 or 2 things first. Also, the recording of this will be available later and it will be on our website. The link, I suspect, will be on our website. We'll put it there. Please contact me or Bill if you have anything else or have any questions. Otherwise, I appreciate it. Thanks for everybody's time. And have a great rest of your week. Take care.
So long.